Good morning. Good morning. All right. Thank you all for coming. I'd like to welcome you to the Trust. It's rare that we actually have so many people come to our hood. So actually very convenient. Thank you for doing that. We're really excited about this upcoming year's program. There's a lot of very new changes. So even for people that have borrowed from the program, say 2 years ago, this program has changed dramatically. Today is our opportunity to stand up in front of you and really discuss those changes and give you the opportunity to ask all of us kind of in one place for clarification. Today's agenda, we're going to start out with DEP. Scott and Karen will be taking their turns to discuss the 2017 intended use plan, the IUP. For those of you that don't know, in order to get our funds, the state's funds from the federal government, we actually have to ask them for them. We lay out all of the descriptions, how we're going to spend the money, how we're prioritizing, et cetera. It's really our Bible. There'll be an opportunity for the public to hear about it, put in comments. That's coming up in a couple of weeks, but again, I'll let these folks from the DEP talk about it. After they get done discussing the IUP, the Trust will go in and discuss highlights and changes. We're also going to discuss the application logistics. A couple of quick housekeeping notes before we get into it. First of all, in your folders, you have a contact sheet. That's a list of literally everybody that you might need to speak to if you've got questions in this program. And a number of those folks are here today. You also have a cute little plastic iPhone holder. And what that is when you go to the beach, it's a waterproof, you fold it over twice, zip lock it, Velcro it, voila, indestructible. So they tell me. Presentations, a lot of folks like to take notes and such. I will tell you that we are going to be, so we've aggregated the presentations. We had a presentation up north on Monday. We're going to have a presentation down in Camden on Friday. At the close of that, when we've got all of our presentations perfect, we're just going to send them out through email so you checked in, you've given us your email, you'll get a copy of everything you see up on the wall today. Okay? With that, we're also going to send out a survey. Really simple. It's 2 questions. And I'm going to ask everybody to please just spend a little bit of time answering those 2 questions. First question is, how can the DEP improve this program for you folks? And the second question is, how can the EIT do it? So from a project, from a logistics, from a financing perspective, we can't improve this program without your feedback. All right? So it's our opportunity to ask you, please let us know. You got ideas, we want to hear about them, okay? If they make sense, we can do them, I guarantee you, we'll do them. Lastly, and very importantly, the Trust has finally entered the social media age. We published our Facebook page 2 days ago, so we're up on Facebook. I don't know a whole lot about social media, except that my kids use it nonstop. It is a great tool, though, I know, when you want to leverage the people that you know and the folks that they know, right? Hence the social environment. So please visit us on Facebook and like us, because through that we will continue to be able to reach more and more of you folks throughout the state. All right, so with that, I'm going to turn it over to Scott Shymon, who is standing in for Gene Chebra.
Good morning, everyone. I'm Scott Shymon. I'm the Bureau Chief in the Division of Water Quality. I'm in charge of the Bureau of Construction, Payments, and Administration. Well, I'm not Gene Chebra, but he's asked me to cover the municipal finance and construction element part and the clean water part, to cover some of the changes that are being proposed in our next intended use plan, which was issued in August, about a month ago. As David mentioned, there's a public hearing on that proposal, and I'll cover that in a slide coming forward. Like I said, I'm here to talk about the Environmental Infrastructure Financing Program, primarily the update and what's new for the 17 program. We just, like I said, we just issued our priority system for the FFY 16, intended use plan, priority system, priority list. We've laid out our plans to allocate principal forgiveness. We've continued basically the same ranking criteria as we have in prior years. And we posted that document on the website. There's the link, and the website now has all the information about every project. We used to generate books that we used to deliver to every county library for people to go to years ago when the program first started. But now we're much more advanced, and it's much easier with all the websites and the links. The big changes for the 17 program are, first year the department's going to be offering 100% DEP interest-free financing to communities in a CSO sewer shed sponsoring construction projects that reduce or eliminate excessive I&I or extraneous flows into combined sewer systems. The idea is to reduce or eliminate the occurrences of combined sewer overflows in the state of New Jersey, and that's also consistent with some of the efforts being put forth in new CSO permits being issued for those projects.
Hey, Scott, can I stop you for a second? So to kind of supplement what you're saying, the importance of a 100% DEP loan is that, well, so first of all, the program's still going to be 75% DEP at zero and 25% of the funds
For the majority of the projects.
Right. And so for the CSOs, you're going to get a 100% DEP loan, so you're not going to pay interest on any of the funds that you get.
Correct.
Basically like free money. So from a savings perspective, that adds up to over 30 years, approximately 14% more of your loan's face value that you would normally pay in the normal program that you won't have to pay. So that's a huge savings for CSO borrowers.
The other thing we're doing is allowing for short-term construction loans and long-term construction loans every 6 to 8 months. Working with the trust is trying to gear up for a bond sale later this year, to start doing bond sales at least twice a year, or when it makes sense from a financing perspective. That's more of a decision for the trust as we move forward. On the DEP side, we're also offering, again, CSO-driven, 100% interest-free financing for planning and design loans for these CSO communities. Included in the permits is a requirement that they develop a long-term control plan. And the process and the steps to get a long-term control plan approved can take up to 3 to 5 years. So we've kind of worked with legislature to allow these terms to go up to 10 years. And if there's a capital improvement project at the end of the planning process, then they can roll the planning loan over into the construction loan and then borrow that for up to another possibly 30 years. If they don't, they'll have to repay the planning and design loan if the result of their long-term control plan results in no capital improvement project that comes through our program. We've also adjusted on the other side for the redevelopment projects. We've adjusted the financing terms where they're going back to getting 50% of their funding from the department at zero interest and 50% from the trust at market rate. It's still a great deal for many of them that can't otherwise access the market. We're introducing the program's affordability criteria. WRDA was approved last year at the federal level and probably had the most sweeping changes to the Clean Water SRF program since it was established in 1987. One of those was that each state needed to develop affordability criteria, and the concept is that states needed to use projects that don't meet the affordability, use their principal forgiveness for projects that don't meet the affordability criteria or for innovative stormwater techniques. And in New Jersey, what we are doing is using our principal forgiveness for CSO green initiatives, which are innovative stormwater techniques, and Barnegat Bay stormwater projects, again, another innovative stormwater technique. So although we've introduced the affordability criteria, don't be concerned with whether you necessarily make it or don't make it. It's really something that all states were required to establish. If and when we change how our principal forgiveness is given out, we would certainly look at our affordability criteria again. Another concept we have proposed is removing the existing caps on emergency loans and supplemental loans. So we're working with the trust to figure out a way to best do this as we move forward into the 17 program. We're also highlighting the program's ability to finance. I mean, we've always been able to finance land acquisition. We started that up actually in 2001. There was an initial burst of projects coming in that were tagging on Green Acres funding and EIFP funding to cover the local share. And over the years, the number of projects has significantly dwindled. So we're kind of lighting the fire under the land acquisition and trying to work with our partners in those programs, as well as agriculture, to highlight the program's ability to work with farmers to install best management practices to prevent water quality concerns. We're also moving to enhance customer service activities. We end up with these lists every year of, I think it was 213 projects in the state 15 program, 279 in the state 16 program. So we're the number of projects the program has and is administering has grown quite large, especially over the past few years, especially since Sandy, actually. So one of the things we're going to be doing to try to interact more with the borrowers is to post a list online, I believe monthly, at least quarterly. We're trying to do this beginning October. So we're having a meeting, I think, next week to go over what final information we're going to be putting out to the public. The idea is that'll be, I don't know, interactive is the right word. We want you guys to look at the list, look at your program and project information, tell us if it's accurate. Granted, with 270, I'm sure there's going to be one or two out there where we've made an error, either just categorize the project wrong or have a typo on a target date. So please, the idea is that you guys look at that list as well and make sure we're on the same page with the project and its progress and when we see it moving forward. For the state 17 program, we're continuing with the base 75% DEP funding and 25% market rate funding for the vast majority of the projects. The only exception is the 100% DEP funding for the CSO communities and principal forgiveness for loans for the CSO who are doing green projects and Barnegat Bay projects. The Sandy SRF program, that was the first group of projects we funded on the clean water side with Sandy money for long-term funding was this past May, and we funded about $100 million worth of resiliency project on the clean water side, and we had about $250 million available. So we're still taking applications for those projects, but we're hopeful and optimistic that we'll use the rest of that money in the state 16 program. But if you don't qualify for the Sandy package and we run out of money, you can always come in for the 75-25. Jeremiah.
Yes, Scott. On the principal forgiveness, I don't know if you're going to go into more detail for the CSO communities. Is that the same 50% for green infrastructure projects up to $2 million per community?
No, it's up to $1 million per community in state 16 for the current borrowers and also in state 17.
Okay, so it's $1 million per community.
Yeah.
And a reserve amount you're holding for that, or not?
$3 million is what we're targeting each year.
Okay.
We're trying to free up more principal forgiveness on the federal side. We actually did get a little bit more than we expected last year, and we're just at the end of this month, we're supposed to be getting the grant award for those funds. Within about 2 or 3, 4 months, we should know better on what the number would be for state 17 moving forward.
Thanks, Scott.
No problem. And again, we have our usual deadlines. On October 9th, you're going to have to submit a letter of intent, and I think it's additional priority ranking information, but the trust will cover some of the submittals you'll need to make by October 9th for the letter of intent deadline. There we go. And again, here the department's expecting to have between $3 and $6 million for 17. We'll know better in about 3 or 4 months after the federal budget. The amount we have for principal forgiveness is based upon the federal allocation, so it is totally out of our hands. How much we're going to get each year, but we have to come out with a priority system before the budget's approved. So if there's a significant change, we'll go out and issue another priority system or a notice or something just to let people know. And I said we're also, besides CSOs, we're continuing our efforts in the Barnegat Bay area. We also have a reserve for equipment purchases. We're trying to work and develop a rolling application process for equipment projects, which are usually relatively easy and can proceed quickly through the program and get approvals. And if that works well, that may be a model for how we handle all projects as they come through the program. Like I said, the department's continued to accept submittals under the Sandy program. One of our biggest hurdles has been utilizing CDBG money. CDBG money is our match to the Sandy federal money, and the CDBG money has a lot of requirements and delays built into their approval processes. So we're still looking. So if you are a 16 project out there and you see that you were impacted by Sandy and anything you're doing as part of your project is considered resiliency, elevating, waterproofing, any of those type measures, certainly when we post this list or make a note to contact your project manager to make sure that they know this project can be classified as Sandy so that we can give you a better financing deal. We want to use up the Sandy money as quickly as possible. When the Sandy money comes back into the program, it goes into the base program. And so that's the way that those funds work. And all applicants, I mean, if you're new to the program and you're submitting a project, certainly if there's a lot of permits involved in it, or if there's controversy regarding eligibility, or you're mixing various funding sources, those are certainly some of the keys where I'd say come in and have a pre-application meeting with us to go through some of the nuances so that we don't jeopardize anybody else's funding. We're still continuing a planning checklist with a planning document so we can kind of go through your review. The SAIL program. This is a trust administered. I'm sure they're going to discuss much more about the SAIL program. It's a short-term bridge loan that we work with the trust to try to work with projects generally to give them money before FEMA money becomes available to them. I'm going to cover some of the water provisions. So this is the Water Resource and Redevelopment Act, I believe it's something like that. This was a new on June 10th of 2014. This was last year. We were kind of surprised by it. It came out of a little left field, and there are established new requirements that certainly impact the Clean Water SRF program. Major changes are the requirement that treatment works projects receiving assistance, and we've kind of maybe broaden that a little bit. We're asking all wastewater treatment projects in the 16 program and the 17 program to develop and implement a fiscal sustainability plan to make sure that our program is in compliance with the federal requirements. Fiscal sustainability plan is much like an asset management plan. It's a new requirement for under the water provisions that impact the Clean Water SRF, and we'll be requiring a certification at closing that you'll develop and implement one for the project. And at final inspection, it's our goal that we will review and make sure that you have one on site. So that is our current plan regarding fiscal sustainability plans as we move forward. Another requirement, our assistance recipients have to certify that they've studied cost effectiveness and selected a project with the greatest potential for water reuse, water conservation, and energy conservation. I believe we're trying to, I don't know if we have, but we were hoping to modify the application this year and last year that as part of the assurances, you would be doing this. But EPA's guidance on this is now kind of asked that states do more than just getting a certification on this. So as part of your planning review for projects, you may see additional comments asking you to see if you've considered these types of cost effectiveness and conservation and reuse types, green type activities and sustainability activities as part of the planning and design for your project. So you may see comments from our staff regarding these activities. One of the biggest changes was where it allowed Clean Water program to go to 30 years. So project loan terms are now still limited to the useful life of the project or 30 years, whichever is less. It codified the Davis-Bacon requirement, which is generally the federal wage rates, and it codified the American iron and steel requirement. And these provisions apply to all Clean Water SRF projects in New Jersey. And if you have questions, you can contact us. I believe I'm turning it over to Karen Fell, who's going to discuss this from the drinking water side as well. Thank you very much.
Alrighty, so my name is Karen Fell. I'm with the Water System Operations Element in the Division of Water Supply and Geoscience in DEP. And I have Alan Dillon is with us. He is also in that program. And after this, we can discuss or answer any of your questions also. Thank you, everybody, for coming out. And what I want to do is just touch on a couple things that are the same with the wastewater or the clean water side of the shop, and then a couple things that are a little bit different as far as conditions go. So we also have our Federal Fiscal Year 2016 Priority System, Intended Use Plan, and Project Priority List documents up online. We've got the proposed plan, which is what we're talking about today, and we've got all of our past plans online also. If you want to go and see those, they're not housed with the Clean Water Program. They're under the Division of Water Supply and Geoscience, but they're up there. Some of the changes that we have that are tweaks of last year, which are, but overall are new over the past few years. We're taking extra efforts to try to get to small systems, to allow them to get them access to drinking water SRF financing. And really, that's one of the main pieces of the federal program on the drinking water side to really help small systems become whole, to improve their lot. We've defined small systems as active public, well, actually, as less than 10, serving a population of less than or equal to 10,000. And by definition, for the rules, you have to either be a public community water system or a nonprofit, non-community water system that's on its own water supply. So that would be like nonprofit, non-community. We don't get a whole lot of those. We do occasionally. We mainly deal with the small community water systems. And then we've also are defining in the IUP active as systems having an active PWID number and have been doing sampling for at least the past 2 years of prior to the period that we're in right now. So we said that in general, small are defined as less than 10,000. We've also further defined very small water systems for the purpose of this program as serving a population of less than or equal to 500. So there's a couple things that are available. Anyway, so small systems serving a population of less than or 500 people can get a DEP only loan, which means no interest. In addition, they have an opportunity to get principal forgiveness loan, which is a grant-like thing. You don't have to pay it back, up to the amount of $500,000. As long as they apply at least, or as long as they supply at least 15% of the project cost themselves by either going to an outside lender, or if they can meet the creditworthy requirements, which a lot of times they can't by nature of being such a small and the nature of the system. But if they can meet the various requirements of the DEP base program, of the SRF program, base program, then they could borrow that money through that also. So anyway, so that's potential of $500,000 as principal forgiveness. In addition, larger systems, and I'll talk more about this in a minute, can use this program, a large system, say if you serve 500,000 people, you can use this program to make infrastructure improvements if you acquire a smaller water system as of 2015. So we're trying to use it as an incentive for where the situation is right for larger systems to take over smaller systems, because sometimes these smaller systems with only like 100 people are just not viable to do all the complex things that are necessary these days to run a water system. So as we said, that very small systems can get a principal forgiveness loan up to $500,000, but they have to supply at least 15% of the project costs. Then, in general, for projects, for systems serving a population of less than or 10,000 people, they can receive a loan of up to $1 million, with broken down as follows. 50% would be principal forgiveness, 25% as a zero interest loan, and 25% as the NJEIT market rate. And then we're going to reach the systems on the list in the priority of the smallest, and then 501 to 3,300, and then 3,301 to 10,000. Now, we do have a number of small systems that could really take advantage of this, and there is only so much principal forgiveness. So I'll talk a little bit in the future about, or in a moment about readiness to proceed, and that's going to end up being important also. And this is what I touched on just a minute ago, that for the federal fiscal year 2016, which is the document, the draft document that we're discussing now, the department will also provide those very small or small water system loans, so that's either the 85% or the 50% of principal forgiveness, to larger systems, to big systems that serve a lot of people, more than 10,000, if they're willing to take ownership of a small system, provided that they are using it to make capital improvements in that smaller system. So we are hopeful that that will, there's probably a few systems that are left that might be advantageous for the small system and the large system. Another piece that we have, a way to use the money in this IUP, which we had in the past, I just wanted to bring it to your attention. It's also related to small systems, is that we have a $400,000 contract with New Jersey Water Association, and systems serving less than 3,300 are able to use a list of consulting firms, consulting engineers that can help them assess the needs of their system and complete the various drinking water state revolving fund applications and submittals. So there's a lot of work that can be done, and I believe that there's no payback on that, right, Alan? That's just a
That's a grant that we give to the systems.
right. So it's a grant to do that work up front. So that's another pretty attractive piece of it.
One thing, small thing, Karen, overall, they also do a general cursory asset management assessment of the system.
Great. So that's for systems serving less than 3,300. So that's a very attractive thing also. And then the one thing that we have in this IUP as a proposal is to limit to $500,000 of principal forgiveness for any one water system in any any small or very small water system in any 3-year funding cycle. And that, as we said before, that we sometimes have like a large company that has 10 systems in New Jersey. Most of them are very big, but they might have one up in the northwest part of the state that has less than 10,000 people. But because that very large company is able to set the rates for the same for all their customers, we are not going to provide that information or provide that principal forgiveness for them to use for their smallest systems, because those people are already in the big pot rate-wise. So this is really just to be looking at, to be available to those individual small systems that aren't part of a larger system. We also are going to provide principal forgiveness to the extent that it's, that we have the money for municipally owned water systems for treatment of a primary contaminant. And again, that's municipally owned systems. And that's like a maximum contaminant level violation. That's one example of a primary contaminant. And it will be broken down as 20% up to, as principal forgiveness, up to $2 million. 40% will be zero interest loans from DEP up to $4 million. And then 40% up to $4 million will be awarded as a loan at market rate from the trust. And then, if the total cost is more than $10 million, then the remainder of that will be the typical 75-25% for all that are available for other projects. We are also going to be starting this year, or with this proposed plan for this cycle, a readiness to proceed criteria, and we expect to give priority status to projects that are ranked and ready to proceed based on the date of project approval. It's the biggest deal when it comes to principal forgiveness. And we expect that we'll look at that on a quarterly basis. So I have a feeling that seems like we've been beating the drum more successful over the past number of years. So I think that we may have a lot of takers on that principal forgiveness. So if you know a small system or represent a small system that's involved in this, I would encourage them to really get in there quickly, as opposed to, as sometimes they can kind of drift along, because it's difficult if you're just a homeowners association. But again, there's only so much principal forgiveness. As Scott had said, we're going to be posting information through Scott's program on the internet that will show the status of projects, and I think that that's going to be very helpful, because it will show whether we think projects are really a go or not. we have projects that have been on the list for a long time, sometimes several years, and we want to flag it to say, you're on the list, but you haven't done the things that we think you need to keep moving, and we're not trying to be mean about it, but we just want to make we know that systems sometimes don't intend to move, and that will be a way for us to communicate that we also don't think that you intend to move. And if there's any discrepancies, that'll be a quick way to get it fixed. And like I said, for principal forgiveness, there is only so much principal forgiveness, so the readiness to proceed criteria can affect it. We are allowed to give up to 30% of the CAP grant out as principal forgiveness, and we do plan to allocate it as very small systems, which is the less than or equal to 500, small systems, and then municipal systems with a primary contaminant issue like an MCL violation. We're also going to be, this year for the first time, reserving up $1 million for equipment purchases, and we expect that for the purpose of that equipment purchase category, it is going to be limited to portable generators and other equipment where construction services, like the installation of a concrete pad to support the generator, are not needed to make the project happen, because that would involve environmental review or something like that, and that's one of the points of this, that there's minimal needed. That's basically it, if anybody has any questions.
Thanks, Karen. So a couple of things, particularly for the engineers in the audience. So you've heard we've eliminated a cap on our short-term programs, and that actually includes our planning and design loan. That's a big deal. I'll tell you that we had a cap before because the trust would provide some of the funds, whether it was 25 or 50%, and we just don't have a big checkbook. That's where we get our funds from. But the construction loan program that I'm going to be talking about and that we'll be developing, we're going to have access to a lot of short-term funds. In fact, Lauren Kaltman is going to be responsible for the development of that. So yes, Lauren, you are now on the clock. And so it gives us the opportunity to provide more than $600,000. From an engineer's point of view, on a planning and design, that's huge. You're now not limited to the smaller projects, right? And so to the extent that your clients want to come in or you're working with them, understand that you can get paid up front for a lot of your work, okay? The second thing is, Karen did a great job really honing in on the very small system loan program. Some of you might know it as the NANO program. And to the extent that those grants that Ellen was talking about are available for the engineering consultants to really help the small system clients get their projects into this program. And I got to say, bless you, working with these types of clients, they don't have the skill sets, they don't have the staff of our normal borrowers. It takes a lot of work to get these folks in. So if you're an engineer, you're on the front line, and there's money available to pay you to help get these folks in. At the end of the day, our interest at the DEP and the trust is to see that everybody has access to clean and safe drinking water, that sewage effluent is taken care of effectively to protect public health and the environment. That's what we want done. So you folks actually supplement and help us with that work. So again, to the extent that you're an engineer and you've got small system clients, there's money available to get you guys paid up front, and to help get your clients' projects effectively done sooner rather than later. Enough on that. Okay, so this is an advanced group. I really don't have to harp about this much, but so I'm going to kind of breeze through it. Why come into the program? In a nutshell, there isn't a cheaper source of funds in the state, period. I don't care what type of project you have or who you are, you cannot borrow for any kind of project. Borrow cheaper than you can get water projects done by coming in to the DEP and the Trust Joint Program known as the Environmental Infrastructure Financing Program. 75-25, at least for the next few foreseeable years until we spend ourselves out of money. Roughly speaking, on a 20-year loan, you're going to save 33%. If you're a AAA rated borrower like my town of Princeton or Ocean County, Middlesex County, you're going to borrow at AAA. You come into the program by getting 3/4 of your money at 0%. Whatever you're borrowing, take a third of that. That's how much you're saving in interest. You're a mayor or you're speaking to council members, that's a really easy, straightforward number to get across to them. That's why they should come in, do the resolutions, and request financing from the trust. Like Scott said, word had just changed, the opportunity, we got the statute passed, the governor just signed it 3 weeks ago, 30-year loans. So you've got projects out there that have useful average lives 30 years or greater, right? Great thing about that is it really makes the use and the amortization of that project more true. Makes the debt service repayment a whole lot easier. You're going to save because now you're getting 0% funds for a longer period of time. Again, if you're AAA rated, you're going to save just shy of 50% of your loan amount in interest costs versus if you go out and you try to borrow those funds yourself. If you're single A rated or triple B rated, add another 5 to 9% depending on your rating and whether it's 20 years or 30 years. Huge savings through the program just on interest rate alone. Other thing is when we do deals, we do pools. So you've got 40 other folks in the pool that are sharing the cost of the rating agencies. We go out, we get all 3 rating agencies rated across the board. It costs me about $125,000 to do that. If you're one of 40 people, you're paying, depending on the size of your program, your project, $2,000, $3,000 for rating agencies. You go out and you do a single rating agency on your own bond deal, it's going to cost you 10 to 15 grand. You multiply that by the trustee, by the underwriter's fees, and you can see even the cost of underwriting by coming to the program is a whole lot cheaper. Cash flow is a great law that was just passed over at DCA. Really going to point over to Rich Nolan and the legal team on this one. But the idea, it was actually called the DCA efficiency law. You no longer, so the trust for the last 10 years hasn't required anybody to put up debt service, okay? So you come in and just the fact that we use the repayments to the state as our collateral helps get us to AAA. It minimizes your collateral requirements. You give us a GO or you give us an appropriate revenue bond to guarantee that you'll repay the program back. That pretty much suffices as far as collateral goes, okay? But getting back to the DCA's law, now municipalities and authorities are no longer required to go in front of the local finance board for approval. You still have to make your pitch to the director, but you don't have to physically go down and present the case. So send your stuff into Tim Cunningham. Tim Cunningham sees that you're part of the EIT, you're below your caps, signs off on it. A little bit more complicated than that. I don't want to steal his thunder, but that's pretty much it, okay? You're also no longer required to come in and ask for a waiver on the 5% down. Again, from a cash flow perspective, you're doing $1 million project, you got to come up with 50 grand. You wanted to buy a police car or put it towards bonuses. You got $50,000, you can do that with. Steve's laughing at me. The inside scoop on local government. So again, just another very positive, one of these things that is so in the weeds, but if you're a council, if you're a mayor, it matters. And then from an administrative perspective, there is a staff at the DEP and the EIT that do nothing but administrative work on this program, reports to the SEC, reports to the IRS. We get letters at least once a year from the IRS. They want to audit a specific project, okay? We deal with them, well, really, McCarter deals with them for us, but we deal with them directly, so you don't have to. You don't have to pay consultants. You don't have to add administrative staff. You don't have to take the administrative staff that you already have and say, I need you for the next 3 days to focus on this instead of your normal job. So again, whether it's cash flow, dollar, administrative, and these are just some of them. So there are a lot of additional benefits than saving 50% of your loan amount in cash. One of the biggest changes that the program is undergoing right now and has undergone in the last decade is we're modifying the format of our loans. In the old days, you come in, you have your engineers, contract, $8 million, we go out, bond you, take the DEP's funds, here's $8 million, put it in an account with your name on it, and as your requisitions come in, you draw down on that account. You're paying interest on the trust portion of that $8 million from day one. I have never seen a project hit an engineer's estimate to the penny. It's impossible. You break open the ground, you got problems you didn't anticipate, you got cost overruns. You got to come back to the trust for a second loan. Or you had a little bit of fluff in your estimate, you come in under budget. Now you got to defease those loans because they're tax-exempt bonds, you got to deal with the IRS. The point is there's a lot of paperwork and a lot of work for everybody. You folks, the DEP, ourselves, at the end of construction. It's additional cost, okay? So what we're doing is we're breaking the loan up into two. We're going to give you a short-term construction loan. It's going to look just like your long-term loan except for the rate. You come in, you sign a short-term loan with the program 75-25. That's the ratio you're going to get all the way through your term loan. Even if 2 years from now you're still in the middle of the construction, the program goes back to a 50-50 program. You locked in 75-25 in 2015 when you started your construction. That's the term that we will give you your long-term loan at. Okay? So the rates, I'll just give you an example. We closed a loan earlier this year. Somebody borrowed one-year funds from us. We went out and costed those funds at 23 basis points. We were 1/4 of the funds that were provided because the DEP provided the other 3/4. So that borrower borrowed funds from us at less than 6 basis points. Okay, less than 6 beeps. It's going to cost me more to administer the loan than they're paying on interest. It will get done in a year. It's that kind of project. We'll term them out next November. Whatever long-term rates are at the time, they'll get 25% of their funds from a bond deal at, let's just assume we're going to borrow at 3%. They'll borrow long-term at 75 basis points. Even if the program was to go back to a 50-50, they will still get long-term funds at 25-75. There won't be any cost overruns. There won't be that we will have to worry about, because if there are, we'll take care of it with the legislature. If the project comes in under budget, we just absorb that through the short-term program. We will give that borrower, just like we'll give you, a long-term loan to the penny of what you need. The other thing about the short-term loan program is, think of it as a line of credit. That $8 million project, okay, we will obligate $8 million so that the borrower can certify that they've got the funds. But we're not going to put them in an account and start charging you interest. You're going to come in with a requisition for $700,000 6 weeks after the project starts. We'll lend you $700,000 and we'll charge you the rate, the short-term rate, on the trust funds on that date. 6 weeks later, you come in for another $1 million. Okay, we'll lend you a second amount for $1 million. We'll charge you at that point the rate. So what happens is you'll only be paying interest on the trust funds that you've borrowed at the point that you've borrowed them. So again, just a cleaner, much more efficient, cheaper way that this program can serve local communities. And that really is, I kind of stole my own thunder on this page, but variable rate funding. So everybody knows that municipalities can't borrow variable rate in the state of New Jersey. Not anymore. The statute for this program was changed this year. This is the only program that I know of that municipalities, authorities could do this, but municipalities can now borrow variable rate for this short-term program. And it's for a period of up to 3 full fiscal years. That's a big deal. That was fun getting. And then when we convert it, like I said, we'll convert it to the exact project amount. Your funding ratio stays the same. Excuse me, that minimizes most of the need for supplemental loans, and that also minimizes or really does away with this under budget defeasance issue and the unliquidated obligations, which you folks don't necessarily deal with, but the DEP, that is a huge issue for the EPA. New Jersey actually does a really great job at it. We actually got written up by the EPA and commended for our work on it. And what happens is if you don't spend the money that Congress appropriates to you, they get kind of bummed at us, right? They do all of this work and say, okay, New Jersey and the other 49 states, we're going to give you X amount of money for this SRF program, and they expect us to spend it on environmental projects. And then, of course, it gets tied up with borrowers who run into difficulties, whether it's the political process, the financing process, the credit process, the engineering process, and the funds sit there. And EPA comes knocking on our door twice a year. One of the first things they look at is, how many unliquidated obligations do you have? Okay, we love to go back to them and say it's like this, because then we get a really good report card and we don't have to worry about, we're not going to give you funds next year because you've got a whole bunch sitting in your bank account that you haven't used. So it's to everybody's advantage to make sure we keep that number low. This program can help us do it. The sale program that Scott talked about. Said it on Monday. I hope none of you ever need to avail yourself of this program, because that means you are affected by a disaster. But if you are affected by a disaster, this is a great program. It is a bridge loan program to help get disaster-affected communities cash very quickly to rebuild or to do resiliency work on water infrastructure. If anybody's ever dealt with FEMA, you know it takes a long time. There is a lot of requirements. There is a lot of paperwork. And just when you get comfortable with your friend over at FEMA that you've gotten to know over the last 6 weeks, they take them and send them to someplace else, and you start all over again. Think of that doing it on a statewide level. You know, we're pulling hair out, and some of us don't have that much left. So it was a real challenge. Anyway, so what SAIL does is we work with you. We're almost like a free consultant. Folks at the DEP, folks here at the Trust, we've spent thousands, and I mean thousands of man hours with the folks at FEMA, but really with the folks at OEM, understanding the Stafford Act, building in procedures to make sure every point along the way, we've got checks and balances. We're dotting I's, crossing T's. I want to mitigate any potential at all that if you take $1 from FEMA, and then we all leave, 5 years from now the Inspector General comes in, and those guys are just itching, right? That's what they get paid for, to recapture funds. I mean, it's really bizarre. You go off topic here for a second. You have a federal government that's supposed to give us money for a disaster, and then they've got another team that 5 years later comes in and tries to take that money back from you, right? Really bizarre. So what the SAIL program does is it gets you cash up front. You come in through the program, we work with you, we do all the reviews. We save everything. I can tell you, I've got a file folder system back there electronically. The very first thing in it is an email from FEMA, which is hard to come by, okay? We have an email that explicitly states that we have a right to use specific sources of funds. So 5 years from now, when the Inspector General comes in and they question the use of those funds, I'm like, wait a second, 5 years ago, your own people said that we could use these funds. We save everything for you. Give a copy to you guys at the end of construction, give a copy to OEM, keep a copy for the program. The point is, 5 years from now, when the auditors come in, there shouldn't be anything that they ask for that you can't provide them because you've utilized our resources, okay? From a cash flow perspective, so the governor's got to declare the county that you live in a disaster area. Sandy, that was easy, all 21 counties were a disaster. The commissioner has to then certify that the project that you want to do is either a rebuild project, so you were impacted and you're addressing that impact, or you weren't impacted, but you're doing a resiliency, but for the fact that the weather stopped 2 miles short of you. If it hadn't, you would have been impacted too. You still should have right to these funds to protect yourself, just like the folks 3 miles closer to the coast that got impacted. So the funds are available to you once we hit those markers, okay? So you come in, we do all the reviews with you, we certify you, you come in and get a loan from us, send us your requisition, we send you the cash. Then we work with you to get all of the paperwork together. We send your requisition into FEMA. We send it into OEM. We have actually a dedicated team at OEM. They know us, we know them, we know what they want. On average, 14 requisitions later, okay, so we've got 3 projects that are active right now and 2 more that are about to go in the sale program. 14 requisitions to date. Average repayment time, 21 days. I challenge anybody in this state, in this country, to match that record. You hear horror stories 7 years later. There are still FEMA requisitions outstanding that haven't gotten paid, okay? It's a great program. Again, I hope you folks never need to use it. If you do, call us up immediately. Enough on sale. Equipment loan program. I'm going to ask Frank to maybe spend some time on this as well. This is actually a precursor to what Karen talked about, readiness. Eventually, in the next 12 to 24 months, this program will be rolling applications. So in the old days, come in October, 18 months later you get your cash. Then we started the interim financing program. Well, if your project's ready, we can get you some cash in advance. Now, if you got a project, you get certified, we'll give you cash. Let us worry about where we get it. We'll get you the cash. Don't let the program stop you from doing a project. And like Scott said, there is a very big focus from the commissioner to make sure this entire program is so much more customer friendly and so much more oriented towards getting more projects done in the ground faster. If you've got an issue, call us. Odds are we're reaching out to you ahead of time if we're doing our job right, okay? So where are we going with this? Rolling application, right? Like Karen said, we ought to know within 3 months who qualifies, who's ready. Let's turn it over again. Let's start another process, another 3 months, another 3 months, another 3 months. It used to be in the old days where we couldn't finance you for term because we'd have to go to the legislature, get the approval, get the governor to sign it. Okay? Now what we've done with the legislature is we've actually gotten them to allow us to give you a lot of short-term cash up front for up to 3 full fiscal years, and then we have to go back to them to term you out. So that's when we need to get their permission to term you out, not construction. And that's what you guys care about. I want to start my project. I'm ready to go. You know, I've got the right counsel. Right now, I know about we can get the project through. So for all different reasons, you want to go with your project? Great. Come into us, go through the reviews, get your certification. We'll get you the cash to start the construction. Once you get construction from the program, you are guaranteed, short of fraud, you are guaranteed to get a long-term loan from us. So you don't have to worry about, oh shoot, I've got this, you know, I might be triple B minus and I've got a short-term loan from, what happens if I get downgraded? I'll worry about that risk. We'll term you out when your construction's done, okay? And what we do at that point in advance is then we go, we make sure your name's on the list for the legislature so that we have the authority to term you out. So the equipment loan program, it is the precursor to this rolling application. As Karen said, you know, the idea is equipment should be easy. You just want to buy something. There's no environmental impact. By definition, equipment is pretty much the mobile stuff, okay? Jet vac trucks. So what's the environmental impact on a jet vac truck, right? You know, Karen Cole's group will still sign off on it, but she's going to, you know, her review on that is much less than if you're going to put in a new waste treatment plant. So it's an expedited process, you know, and we are publicly stating that you come in and we'll get you certified and ready for cash within 60 days. You need cash to purchase this. Great. Doesn't matter when it is. Maybe you want something in February, maybe you want something in October. We'll get you the cash to purchase it, and then what we'll do is it'll be a short-term loan. We'll term you out the very next bond deal we do. Again, as in all projects, the term of our loans, our long-term loans, are limited to the equipment or really the project's useful life. 30 years, this is the other really big deal for the program that came into being this year. So, as Scott said, we're to change the rules. The clean water side now has the ability to lend useful average life, but no longer than 30 years. If you're, I mean, everybody here has a mortgage pretty much, right? You've looked at 15 years, you've looked at 30 years, you got to pay your loan off in 50 years. It's a much bigger monthly payment than if you're looking at 30 years. And your house has a 30-year average life, so 30 years, that's why the bank lends them. Makes sense. If you want to take a 15-year loan out for your house, you're more than welcome to do that. If you want to take a shorter loan out from the program, we'll never say no. We have a lot of conservative municipalities that like to put limits on their lending and don't always go to the end of the useful average life of the project and prefer to pay it off sooner. That's okay. The point is, these projects, waste treatment plant, 50-year useful life, you get a 20-year loan for it, you're really forcing the cost of that treatment facility onto the people who are going to be living in your community for the next 20 years. And for the people for the next 30, they kind of get that for free. So this really, it levels the playing field. It certainly makes the debt service payments and the financial planning for your local officials a whole lot easier. It is a great thing that we got this. Like I said, the amount of funds that you're getting to borrow at 0%, you're getting to borrow them for a longer period of time. So now it really increases the attractiveness of this program. And then lastly, I know that there are a lot of municipalities that, if they're, we used to say, well, why should I borrow 20 years when I can go do 30 and 35 locally? Okay, so basically it is competitive with what you can do independently. There really shouldn't be a reason why any municipality or any authority representing municipalities does not come in to this program to borrow for their water infrastructure needs. Before I turn it over to Frank Scangarella to talk about our logistics, any questions on anything that I've said? Yes, sir.
How's the process going to be going from the short-term to long-term financing? I mean, it's just, again, involving bond counsel and doing a typical closing?
It should be, actually, so yes,
Yeah.
You're right about that. It should be a whole lot easier than that, though, because a lot of the stuff that you're going to need to take out the short-term loan, so all of your exhibits, right? So a lot of the work that the lawyer will be doing in aggregating on your behalf is already going to be done. So you're still going to have to do a resolution, right? You're still going to have to give us now, instead of a note, a bond with an opinion behind that bond. But outside of that,
To David's point, a lot of the official action will be taken up front before your short-term loan. So if you're a municipality, your bond ordinance will be in place. You might adopt a separate authorizing resolution for the short-term loan. We provide standard forms for your consideration. Or your bond counsel might be comfortable addressing delegation issues in the bond ordinance itself. Then, when you reach the point of completion, when you're ready to convert to long-term, your bond ordinance is already in place. As David said earlier, we've streamlined the process for interacting with the Division of Local Government Services. There's no need to go to the local finance board. It would require an authorizing resolution at that point to approve the forms of the trust loan agreement and the fund loan agreement. So it's pretty streamlined with most of the most substantive corporate authority issues addressed up front.
so, to that point, I could understand if there are certain bond counsel in the state that might not be happy with the changes. I can't imagine that a closing for the long-term loan, since it doesn't involve as much work, would be as expensive as the first closing. But I'm going to make the point to the bond counsels and to everybody else, look, what we're doing is we're trying to make it easier for more people to come in and do more projects. So we're really looking to increase the volume that comes through this program. And actually we will. So there's going to be a lot more work for everybody, which is a great thing. Yes, sir.
Good morning. The equipment loan program, what's the loan rate and is it less for small systems?
Okay, so our lending rates are determined, the amount of funds that you get for equipment loan program will be no different than the amount of funds, the ratio of funds that you would get for any other short-term loan. So if the program is currently a 75-25 program, which it is, anybody that comes in for a program accepting the principal forgiveness type projects is going to get a 75-25 loan. If you want to borrow equipment or you want to come in and borrow funds for a waste treatment plant, we're going to give you short-term loans, 75% at 0, 25% at the short-term rate, okay? If you're a small system, what we might end up doing is we might end up giving you a direct loan instead of, so Lauren is going to go out and set up a program where we can go borrow from JP Morgan or Investors Bank. And we just pass that rate through as that's our source of funds. We just pass those funds through to you, we pass that rate through to you, right? And again, it's going to be somewhere around 25 to 30 basis points for a one-year loan. On a direct loan, what we actually do is we go look at an index, because I'm not physically going and borrowing money from Provident Bank. I'm not going to go and tap my commercial paper line of credit at JP Morgan. So since they're not lending me money and giving me a specific rate, where do I get the rate from? There's an index for short-term municipal AAA loans that we actually look at, and that's what we set. So to answer your question, generally speaking, it's all the same. There are nuances for very, very small loans, but we try to get to the same place.
Just as a follow-up, so for small systems, the equipment loan could possibly be less.
Could possibly be less than what we would get from the market at that day, but I wouldn't know until that day.
Thanks.
Yeah. Anything else? Okay, we turn it over to Frank Scangarella.
Good morning. My name is Frank Scangarella. I'm Assistant Director at the Trust. I'm going to be covering some logistical issues, primarily the application schedule. And as you've heard a number of people say, there have been a lot of changes. I'm actually from the borrower side, so I'm very sensitive to a lot of the complexities that the program has, and we spend a lot of time trying to make it simple. So given the statement that there's a lot of changes and that you're on the borrower side and we're trying to make it simple, how do those things work together? I think if I could leave you with one thought, it's by the time the dust settles in the next year, you're going to find out that the program has been significantly simplified, and I'll actually spend 2 slides talking about what you should focus on as project sponsors as opposed to your consulting engineers and your bond counsel, because our lives or those folks' lives tends to be somewhat complicated in this program. One other thought, we spend a lot of time complying with state and federal requirements. You heard us talk about the intended use plan, there's state legislation. We're really making a lot of efforts to kind of keep you distance from those things. So we'll go through the application schedule. One of the big changes you heard is the construction loan program. And what we've tried to do is remove a lot of the deadlines from the program. As David mentioned, next year, we're hoping to get to a rolling application program, and you're seeing kind of the genesis of that in the equipment loan program. We actually have 2 deadlines for the construction loan program, but before I get into those 2 remaining deadlines, so let me tell you what I know off the top of my head. So we have planning loans, and for the new loan structures, what you're going to realize in the coming year is that you can actually close on a short-term loan at the very beginning of a project before your construction's approved. We call them planning loans now, but basically what you'll be able to do is apply for a planning loan anytime throughout the year. You can do that right now, same as equipment, and you'll be able to close on that planning loan when the program certifies. And we can actually certify to that within 30 days tops, or actually worst case scenario. You can actually close on a planning loan and have the entire project cost built in to that loan, recognizing that you're only going to get the planning funds up front. What that does is it reduces your cost of borrowing, so you only have to get a single opinion letter from council. And as the project goes through construction and an operable segment is, or the project itself is certified, right? At that point of certification, in the context of a pre-existing loan, is that still moving?
No, I'm gonna.
Yeah. Thank you, Victor. We will make those funds available. So you can come in at the very beginning of a project. You know, this 10-year CSOs is a good example, right? You come in early, geez, we want to get a planning loan. Okay, here's, we need $200,000 for a $10 million loan, a $10 million project. You can close on the $10 million project loan, okay? You're only going to get the $200,000 for planning and design up front, but then as that project goes through and gets its approvals, you will be able to get those subsequent approvals going forward. Now, that's actually a feature of the program that exists right now. And we really don't talk about it a lot because it's a small piece to a lot of big program changes. But just understand, to go back to the first slide that you saw for about a second. There it is again. You can come in at any time throughout the year for a planning loan. It's an online, quote-unquote, application. It's very simple. I'll talk about that at the end. And you just create your project, submit a short-term loan financial addendum form. You'll receive certification in 2 weeks up to a month, and you can close on your loan at that point. Equipment loans, I kind of include that in this slide only because it can be applied for at any time. Okay, it's not subjected to the regular programmatic deadlines, but it is required to be approved because technically in the program parlance, it's basically a construction loan as far as the program is concerned. You're purchasing a hard asset. So getting into the construction loan, you know, this is like the bread and butter program for this program, what everyone's used to experiencing here. Everyone here is in the program. You're used to kind of seeing this program. You hear us talk about the letter of intent deadline, which is October 9th, and the application deadline, which is always in March, and now it's March 4th, I think. So here, the idea is, these are the only two deadlines that are left in this program, okay? The problem with the October 9th deadline, it really doesn't even apply anymore. You can submit the letter of intent as late as March 4th. As long as you get everything in by March 4th, you're good to go in this program. Again, as I said earlier, there's things we really want you to focus on and things we don't want you to focus on. If you're going to focus on anything, just focus on these two dates in terms of getting documentation in, and I'll talk about kind of technical documents later. So, again, I won't spend a lot of time because you folks are used to this. The letter, you identify your project online. There's a letter of intent, which actually includes the planning and design documents, and then applications due in March, as well as the engineering plans and specs. We're also having, some of you folks know what a track 2, or I forget what we used to call it. We're doing that again this year, and that'll be March 4th as well. So at that point, in years past, what we would do is we would talk about all of these really complicated dates that really don't apply anymore because we're going right into a construction loan. And as a project sponsor, you need to just focus on the fact that staff is going to be reviewing your project. And at one point in time, upon all the receipt of approvals, environmental planning approval, engineering design approval, SED approval, a number of other things we can go into detail on, you will be receiving an authorization to advertise. And at that point, it is recommended that you work with your bond counsel to submit your short-term loan financial addendum form if you haven't already done it in the context of a planning and design loan. Once you receive the authorization to award construction, you will be, and assuming you pass the financial review, creditworthiness issues, you'll be able to schedule and close your construction loan. We always chase this, we used to chase this February 1st deadline of, oh geez, am I going to get my authorization to award? That doesn't apply anymore. Just focus on when you're going to get your authorization to award construction. Provided you've worked with bond counsel or your general counsel before that, you'll be in a position to close on your loan immediately. Okay, I received a construction loan. When will my project be eligible for a long-term loan? Again, last year, we are chasing this authorization to award concept by February 1st. Now it's a percentage of construction completed approximately 45 days prior to bond sale. So if you're coming in the program this fall, you would kind of look to see, is it possible for my project to be, 10% complete by this fall, which obviously is not going to happen in this coming program year, but last year we have folks in that camp. And by March 4th of 2016, we're looking for 35% construction complete. That would be by March 4th, that's right. And by October 8th of next year, 2016, we're looking, I think, somewhere around 65% construction complete. And then finally, March 2017, we're looking at 100%. Again, there's question marks there. You kind of get the concept of what we're trying to work with here. In essence, we're trying to get folks used to working in the context of a construction loan, kind of easing everyone into it, increasing the amount of construction that we're trying to get completed by the time we get ready for bond sale. You will be funded for construction, right? This doesn't talk about your eligibility for funding. This merely talks about when we're going to take out that construction loan with long-term financing. Again, you'll be eligible to receive funding for your project as soon as you receive the authorization to award construction. So now that we're going into this construction loan program, how do you predict when your project may be eligible to be financed in a long-term deal? Again, recognizing your project's already received short-term funding. So basically what we're trying to do is really incentivize borrowers to work more closely with their construction managing engineers, and more importantly, to have construction management engineers work closely with bond counsel so that there's better communication of information as to when a project is going to achieve the milestone of construction completion by a certain date. So the recommendation is, for as your project goes through the system, right, you'll receive your construction loan, and what we would like you to do is maintain a realistic construction schedule. And we would like you to use H2 loans to do that, so that when you look forward and you plug in the numbers to say, we should be construction complete at 5% by this day, X% by this day, and you maintain it in H2 loans, as you update your construction schedule in H2 loans, you will automatically be sending emails to your client, to your bond counsel, et cetera, so that everybody will be updated as to where your project is. And by the way, this helps us too, because we use it for our own internal forecasting, for replenishment of funds, as well as for kind of scheduling our bond sale. So here's the do's and don'ts, okay? Now again, this doesn't apply to bond counsel and consulting engineers and FAs for that matter, but this really applies to kind of the governing individuals, the directors, the town council, the mayors of the towns. Don't focus on fiscal year. Don't focus on the state of New Jersey the project priority list and state of New Jersey appropriations, any dates other than the letter of intent in the application. Don't pay attention to anyone who claims your project won't be funded if your project doesn't get approved by a certain date. Your project will get funded, okay? We spent many years confusing ourselves and unfortunately confusing you with this stuff, and it's not appropriate, and it's also wrong, okay? Just focus on the really important things, which are, understand if your project is eligible. Now, this is easier said than done, okay? If you have any questions, just understand, geez, my project's in the program now, it's 25% market rate. Is it going to be 25% market rate next year? Really good question. What about costs? What about principal forgiveness? Things like that. If you have any questions, give us a call, because we know that that part is confusing, but really that's where we would prefer that you focus your efforts. There's also these cross-cutters, so there's the extra fees. Again, there's only 2 program deadlines. Don't worry about anything else. And understand what information you're required to submit in these 2 deadlines, in these documentation, as well as what information is being required of your consultants, okay? Obviously, that's why they get paid to do that, but you need to keep yourselves informed. Push us and your team to really do what's most important to you. It's not to comply with this program for all the nuances. It's to get your project under construction. We will ensure that all these things get taken care of working with your consultants. And also, just kind of a footnote issue, there is technically kind of a deadline issue for short-term loan financial addendum form, which we covered before. So borrower bond counsel and financial advisors is a note here for you as well. There is a long-term loan closing. This is for the schedule for 2016. So if you're in the program now, this actually could apply to you. It certainly won't apply to anybody that's coming in this coming fall. So to get your clients positioned for the May bond sale, again, this gets back to that forecasting question. Will 35% of your construction be complete by March 4th, right? And if so, here are the dates that kind of will apply to you. There's also a bond sale being scheduled for this fall, okay? If you think that your project is going to be 65%, and there's kind of a question mark there because I don't think that's been kind of confirmed by David and senior management at DEP, by October 7th. And by the way, that's a requisition submission date, okay? Construction incurred, but requisitions also submitted by October 7th, 2016. Then here are the dates that will apply to you as well. Again, this has nothing to do with your project receiving funds for construction. Your project's under construction, you're getting that construction complete. So now moving into kind of something that folks from DEP and EIT know that we spend a lot of time working on that we really don't want to get you pulled into. Anyone who's in the program, and that's most of you, are used to using H2 loans. Doing a lot of changes that you really won't notice too much up front, but you will be seeing some benefits, and I think we'd rather under-promise and over-deliver. You're going to be seeing a lot more transparency in the program. When you come in with new projects, you'll see that you will be receiving a communication of the team that's assigned to your project and the contact information. You'll be receiving status updates of your projects, and that's through the online submission program. If you don't have a user account, which I suspect most, if not everyone here does, you will call Mary Pearsall, who's at the back of the room. She's our unofficial mayor here because she knows everyone and deals extremely efficiently, and I mean that very positively, with everyone here. And the reason we start, why do you start an online program with a telephone call? Because we want to confirm you are who you say you are and that you represent who you say you represent. And then basically for folks that really aren't too super familiar with it, we use a lot of application roles. Anybody who uses Sage kind of understands what I'm about to talk about here. There's kind of three kind of layers of roles here. One is the authorized official. The next one down is authorized representative. And the third down, the collaborators, the folks that can contribute but can't submit. So the authorized official knows the FEID numbers, knows the location of the facility, is basically the business administrator or somewhat senior level in that governing unit, assigning to the authorized representative, who's the individual who actually creates projects. The example I like to use is Newark. They come in, and the authorized representative who is assigned by the authorized official. It's the director of public works for sanitary sewer. Somebody else does it for drinking water, and a third person at Brick City does the redevelopment. So you have three different people involved with the city that each do their own silos of projects. Now, the authorized representative for each one of those silos has the authority to assign collaborators. Any and everyone they want to be able to go in and work on the project and make, changes or submissions or suggestions and changes, they can do that. But ultimately, the authorized representative is the individual that's got the responsibility for doing the submission. We do ask that you not share usernames and passwords. If you find that you have an incentive to do that, it only means you don't understand kind of that the program can accommodate other people using it as well. So that's the applicant roles. H2 loans, again, stay tuned with some of the program changes. We're doing a lot internally. Externally, what you'll see again is just greater transparency as we move this program forward into the future. We've got a staff of like 8 IT people that are working on this full time, but thousands of hours working and improving the software so that basically the entire project process, not just the application review, loan approval, requisitions in the next couple of years. We're just kind of starting that now. That process will actually be submitted online as well. So I think that's everything I have. And is Rich speaking? No. So with that, I'll turn it back over to David.
Thanks, Frank. Just a couple of things that I wanted to highlight that Frank talked about, and contacts. So we have two partners in this program. We've got the technical side that's handled by the DEP and the finance and legal side, the credit side that's handled by the EIT. If you have questions about your project, call up anybody. Yeah, I wouldn't recommend that, okay? I know this program incredibly well. I'm not the DEP. I don't do technical reviews. I'm not going to know it as well as Gautam Patel or somebody in Karen's group. If you have a project question, please contact the DEP. Do not call the EIT. As much as I would like to help you, as much as my staff would like to help you, and we will, okay? I'm going to tell you who you should be talking to at the DEP. That's okay. Don't come to us for technical questions. Conversely, don't go to the DEP for finance or legal or credit questions. If you need to know who should handle that here at the trust and you're talking to them, by all means. But do everybody a favor. Technical reviews get handled by the DEP. Financial issues get handled by the EIT. Definitely want to highlight that. And then the other thing that I want to supplement what Frank was talking about is Frank and his team really designed H2 loans to follow SAGE so that there was familiarity from your folks' perspective. The collaborators are key. They're not just key right now, kind of before the project. They're also really key after the project. And one of the things that I'm really excited about is we've started to work on the requisition process. Sometime within the next 12 months, hopefully, all of your invoices will be submitted through the web. Okay? Which is great because then everybody can work on them in parallel. It's not paper that has to get passed. I can tell you right now, I think we do a pretty decent job. I generally sign off on stuff 21 days on average, maybe a little bit shorter than that when you send them into the DEP. So we're pretty good about getting checks and payments out, wires out, before your contractors need to get paid, all right? But it's still paper. So by the time I get it, 7 people have signed off on it, checked it. Okay, wouldn't it be great if it was electronic and a couple could work on it at the same time or immediately instead of shipping it? Actually, we get them delivered, hand delivered. That takes a day. I can cut that down to 10 minutes if I do it electronically. So really excited about just this portion of H2 loans, and what's going to happen is your collaborators are going to send the information to you to submit to us because you're going to be responsible for checking it, right? And if your collaborators aren't identified, if you're not using H2 loans, all that efficiency, cutting down time, like I talk to contractors are agog about this. Right? Because from their perspective, they're going to be able to submit their invoices to you guys and hopefully get immediate turnaround. They're not going to have to go to their bank to borrow to pay off their subcontractors. That's a line of credit that they got to pay for, that they charge the municipality and the rate users. So again, at the end of the day, this is really about efficiency. It's really about time management. So just understand, everything that we've got set up, it's really with your guys' best interest in mind. If you've got ideas on how to change it, please let us know. We're all ears.